Hey everyone, thanks for clicking. You're looking to ditch being poor and build wealth just like Warren Buffett, right? That's exactly what we'll be tackling in this video. We'll break down powerful strategies to unlock your financial future. But wait, there's more. At the end, we'll reveal a secret bonus tip most investors miss. Buckle up. This is going to be epic. We've got a roadmap to success. We'll cover the fundamentals, explore Warren Buffett's investing wisdom, and unveil practical steps you can take today. Plus, that bonus tip at the end could be your golden ticket to wealth building. Before we dive in, hit that subscribe button and smash the notification bell so you don't miss a beat. Start investing early. Investing early is one of the most effective ways to ensure financial growth over time. By starting your investment journey at a younger age, you give yourself a longer horizon to grow your funds through various market cycles, benefiting from the upswings and learning to manage during downturns. An early start in investing does more than just enhance your financial growth. It also builds your experience and boosts your confidence in making investment decisions. For young investors, this period is less about immediate returns and more about developing a robust understanding of how different investments behave under varying economic conditions. This hands-on learning is invaluable as it allows young investors to make informed choices and develop a personalized investment strategy that aligns with their long-term financial goals. Moreover, young investors are typically in a unique position where they can afford to take on more risk. This is because they have the time to recover from potential losses, unlike those closer to retirement. High-risk investments often come with the potential for higher returns, and having the time to ride out the volatility of such investments can be particularly advantageous. Tax benefits also play a crucial role for those who start investing early. Contributions to retirement accounts are often tax-advantaged, and maximizing these benefits from a young age can significantly increase the growth potential of these funds by reducing the tax burden over time. Embrace financial education. Understanding the basics of personal finance and investment is critical for long-term financial success, and the earlier one starts, the better. Financial education helps in making informed decisions about investments, savings, and spending. By gaining knowledge early, individuals can avoid common pitfalls like high-interest debt or poorly diversified portfolios. Financial literacy also empowers individuals to take advantage of various financial products and understand the market trends that affect their investments. Moreover, as young adults often have fewer financial responsibilities, it's a great time to experiment with different types of investments to see what works best. This practical experience, combined with theoretical knowledge, can significantly enhance one's financial acumen. Learning about the importance of budgeting, the impact of fees on investment returns, and the benefits of long-term versus short-term investments can all contribute to more robust financial health. In addition, embracing financial education early can lead to more disciplined spending habits. Prioritizing investments over immediate gratifications can set a foundation for a lifetime of financial stability. Understanding how the value of money changes over time helps people see how their financial choices affect their future. Got any strategies that have worked for you, or need advice on financial planning? Drop your questions or tips in the comments below. Don't miss the bonus tip at the end for a Buffett-inspired investment insight. Invest in what you understand. Warren Buffett's strategy of investing in what you understand is crucial for long-term success. By focusing on industries or companies that you are familiar with, you reduce the risk of unexpected outcomes and are better positioned to make informed decisions. This principle is not about shying away from opportunities. Rather, it's about making sure you fully understand your investments, which is essential for managing risk effectively. For example, if you have a background in technology, you might be more comfortable and successful investing in tech companies because you understand the market dynamics and what makes a tech company likely to succeed. This familiarity allows you to identify undervalued opportunities and avoid potential pitfalls that those unfamiliar with the sector might miss. Moreover, understanding your investments leads to greater confidence in your decisions, which in turn can prevent rash decisions based on market volatility. It's easier to hold on to an investment and ride out market fluctuations when you understand the fundamentals driving its performance. Additionally, this approach minimizes the likelihood of falling for hype or getting involved in investments that don't align with your long-term financial goals. The value of patience. Patience is a critical component of successful investing, often highlighted by Buffett's long-term investment approach. The financial markets can be volatile in the short term, but historically, they have trended upwards over the long term. By maintaining a patient approach and focusing on long-term gains rather than short-term fluctuations, investors can capitalize on the growth potential of their investments. For instance, it's well documented that investors who remain invested through market highs and lows typically achieve better returns than those who attempt to time the market. Market timing is incredibly difficult, even for professionals. Missing just a few days of significant gains can drastically affect overall investment returns. As investments grow, they generate earnings, which are then reinvested to generate their own earnings. Over time, this cycle can significantly increase the value of an investment portfolio, provided the investor has the patience to allow this process to unfold without making hasty decisions that could disrupt the compounding process. Learn from mistakes. Even Warren Buffett has made investment mistakes, but he has used these as learning opportunities to refine his strategies. Learning from mistakes is a fundamental aspect of becoming a successful investor. Acknowledging errors in judgment or execution can provide valuable insights that enhance future decision-making. For instance, early in his career, Buffett invested in a textile company that struggled to generate profits. Instead of clinging to his original decision, he adapted his strategy, eventually shifting his focus to insurance and other investments that offered better returns. Being able to bounce back from mistakes shows you're good at investing. Moreover, embracing mistakes as part of the learning process helps investors develop resilience and improve their analytical skills. It encourages a mindset of continuous improvement, where each investment decision, good or bad, is seen as a step towards greater understanding and proficiency in navigating the financial markets. The importance of diversification. Diversification is a cornerstone of sound investment strategy, famously championed by Warren Buffett despite his preference for concentrated bets on highly understood businesses. Diversification helps mitigate risk and reduce the volatility of an investment portfolio over time. It involves spreading your investments across various financial instruments, industries, and other categories to enhance potential returns, while lessening the impact of poor performance in any single investment. For example, instead of investing all your money in one stock or sector, spreading investments across different sectors such as technology, healthcare, and consumer goods can protect against sector-specific downturns. Diversification involves incorporating a variety of asset classes like stocks, bonds, real estate, and international opportunities into your portfolio, each responding uniquely to different market conditions. The rationale behind diversification is simple. It's unlikely that all sectors or asset classes will decline at the same time and to the same extent. By diversifying, you're not putting all your eggs in one basket. Instead, you allow the stronger parts of your portfolio to balance out the weaker ones during market fluctuations. This strategy is crucial for long-term investment success because it gives your portfolio a chance to withstand market shocks and achieve steadier, more consistent growth over time. Ready to take action and transform your financial future? Don't forget to like this video and subscribe for more wealth-building strategies. Great news! I've got a whole bunch of videos on my channel packed with ways to boost your finances. Just search for my channel and explore. What stuck out to you most in this video? Leave a comment below and let's chat about building your financial future together. We can all be money masters.